Hello, I'm Phillip Smith, financial planner with Tide Pool Wealth Strategies, dedicated to helping late career professionals navigate the tides of retirement planning with clarity and confidence. This is your retirement planning guide to money management, pursuit of long-term financial growth, and creating an adaptive strategy tailored to your unique and evolving journey. In every episode, I'll share concise, actionable insights to help you plan a retirement of purpose, resilience, and confidence. Welcome to
The perfect retirement plan?
Welcome to today's episode. I'm glad you're here. With an increasing frequency, I find that many people getting ready to retire run up against a psychological hurdle, and it goes something like this.
I've been saving my whole life. I've had a paycheck for 42 years. When I think about retiring, think about not having a paycheck, it scares me.
When I hear this, I recognize that it isn't fear in the real sense. It's anxiety over the unknown. Like an introvert walking into an auditorium of people, it's unknown, you're uncomfortable, and the one thing that will make it better is a burst of confidence. I believe knowledge, education, can alleviate anxiety and help us to take action with some level of confidence. That's where we are today. Today, we're wading into the depths of a critical question. Where will your retirement checks really come from? Understanding the various income streams available in retirement is key to building a stable and fulfilling financial future. And identifying what's available can help you to feel more confident about life beyond the paycheck. Now, before we dive in, if you find our discussions helpful, please subscribe to the podcast so you never miss an episode. Listeners and viewers like you will help us to reach even more people in search of retirement planning guidance. And if you're curious, I include links to my sources at the end of my transcript, which serves as my show notes.
Hey, Phillip, I'm just going to go ahead and hit this with the disclosure since it's relevant today. All investing involves risk, including the possible loss of principal. There's no assurance that any investment strategy will be successful.
Thanks. Now, let's begin by exploring the primary sources of income you might tap into during retirement. Social Security is probably the first one that comes to mind, a government-provided benefit based on your earnings history. It's a foundational income source for many retirees. And while there are concerns about what Social Security will look like a decade from now, there is no good and substantiated reason to believe that it will disappear. For many retirees, Social Security is the primary source of retirement income. It's noted in a recent article by The Motley Fool that if a retiree is increasingly reliant on Social Security for their retirement income, they are also increasingly less financially comfortable. This emphasizes the importance of ensuring that we, as individuals, are doing our part to save for our own retirements. A tax note, depending on your total income, anywhere from 0 to 85% of your Social Security income may be exposed to federal tax. In some states, like Oregon, there is no tax on this income source. That makes this more tax efficient than earned income and most pension benefits.
It's interesting to note that according to recent data, 92% of retirees over 65 receive Social Security benefits, making it a cornerstone of retirement income for many.
Absolutely, Cash. Social Security often forms the bedrock of retirement income, but relying solely on it may not be sufficient for a comfortable retirement. Which leads us into another potential income source, the pension. These are employer-sponsored plans that provide a fixed regular income after retirement. They are far less common amongst companies than they used to be, but we do see our fair share of state government and education system retirees with Oregon's Public Employees Retirement System, or PERS, pensions. A pension can be a significant income source for those who worked within an organization that offered it. Rental income is also a possible retirement income source. For those that are unfamiliar with the concept, one could potentially generate cash flow from leasing out property that you own. This can provide a steady cash flow if managed effectively, depending on the type of property, the leasing agreement, maintenance, property taxes, and quite a few other factors. This could be very lucrative, or very time-consuming, or very costly. This one can take quite a bit more care than a pension or Social Security, and it offers no guarantees. Tax tip. This income is taxed differently and a little more efficiently than earned income. Between this and Social Security, a person could conceivably generate the same amount of income as when they worked and pay notably less in taxes. Now, if you like guarantees, and if you don't have a pension, then another option for income is an annuity. I say, quote unquote, if you don't have a pension, because if you have a pension and Social Security, you already have two lifetime fixed income sources. An annuity as a third fixed income source can become an increasingly unnecessary tool, potentially causing too much of your income to be constrained by a fixed payment structure. So, what is an annuity, you ask? Thanks for asking. It's a financial product, technically an insurance contract, that offers a guaranteed income stream, typically offered by an insurance company. Annuities today offer quite a bit more than just income, but the income, usually a lifetime income stream, is the most widely known and widely used aspect of this kind of financial tool. And usually, they get funded by placing some of your other savings or retirement accounts into the contract. Which brings us to talking about retirement savings accounts, like 401ks and IRAs, as another potential and increasingly foundational retirement income source. This potential income source is a result of your personal savings efforts accumulated during your working years, intended to be drawn down during retirement. Okay, so we've outlined some common retirement income sources, all potentially viable ways to provide that retirement check. Let's take a shallow dive into the advantages and disadvantages of those income sources. First, Social Security. It provides a lifelong inflation-adjusted income and offers spousal and survivor benefits. However, it may not fully cover living expenses, and the benefits can be taxable depending on your income, and there are future solvency concerns, with the current potential risk of the benefit being reduced by almost a quarter of the current benefit structure if lawmakers don't take action soon. Next, pensions. These offer predictable, regular payments. Like Social Security, these can reduce or serve as a hedge against longevity risk. And that said, these are far less prolific in the private sector than they used to be, and they can have potential vulnerability to employer financial health. Some pension benefits don't offer inflation adjustments, resulting in an income source that doesn't keep pace with inflation. Then there's the good and bad of rental income. Now, this would offer the potential for steady cash flow, property appreciation, even some potential tax benefits. However, the common concern I hear from retirees is that this requires active management. There's a risk of vacancies, which can cause fluctuations in income. There's also maintenance costs, market volatility, property taxes, property insurance, and a number of other expenses that come along with this passive income source.
When I retire, man, I don't want to work for my retirement income.
Everyone's retirement looks different, buddy. Okay, we also have annuities. Again, these are primarily known for offering some form of guaranteed income for life. They often have customizable payout options, and they have the benefit of tax-deferred growth, which can be pretty nice. However, these have commonly had a well-known history of high fee structures, misunderstood fees, periods of relative illiquidity that can result in surrender charges. Sometimes these can be pretty complex. Leave it to insurance companies to take, quote unquote, we'll pay you a monthly income for the rest of your life, and make it super complicated. Nothing against insurance companies. I have multiple types of insurance for myself and my family, and there is value in all of it.
You know, Phillip, it's worth mentioning that while annuities provide guaranteed income, they often come with higher fees and less liquidity compared to other investment options.
Which is why I mentioned it, but saying it again does reiterate that it's an important consideration, Cash.
Oh, and listeners should know that when you say guarantee, that guarantee of an annuity is backed by the claims-paying ability of the issuing insurance company.
That's true, which speaks to the importance of working with insurance companies that consistently carry a high credit rating with the well-known rating agencies, Moody's, Standard & Poor's, and Fitch. It means that they carry a high level of capital and typically a very manageable ratio of potential claims to total dollars available to cover those claims. So where are we? Oh, lastly, retirement savings accounts. These offer flexibility in withdrawals. There is the potential for investment growth, and depending on the type of retirement account, there may be tax advantages. It's important to note that distributions from traditional IRAs and pre-tax dollars from employer-sponsored retirement plans are taxed as ordinary income and, if taken prior to reaching age 59 and a half, may be subject to an additional 10% IRS tax penalty. The primary knock on retirement savings accounts is market risk. There's also the possibility of outliving your savings, and when it comes to pre-tax money in a retirement plan or the balance in a traditional IRA, there are required minimum distributions, or RMDs, to contend with, beginning at age 73 currently. Understanding the trade-offs of each income source is essential for effective retirement planning. Okay, so we've covered these common retirement income sources, and we've briefly outlined some primary advantages and disadvantages of each. It seems like a good place to talk about the potential ways someone could combine these different income sources. Diversifying your retirement income can enhance financial security. Here are some strategies to consider. Layering income streams. One version of this is to use those fixed income sources, annuities, pensions, Social Security, to cover your essential expenses. Then, rental income, if you have it, or retirement accounts can be sourced for discretionary spending. The thinking with this is that discretionary spending is at your discretion. In other words, it fluctuates based upon your wants, not necessarily your needs. It may work best to use income sources that have more potential variability. As mentioned, net income from rentals can fluctuate. Likewise, market volatility can make a person a little more thoughtful about when and how much to withdraw from a retirement account. If you don't have a pension, a pretty solid backup income option is to ladder annuities. This means you purchase multiple annuities with different start dates or with the flexibility to turn on the lifetime income benefit at different times, so many years apart, to create a staggered income stream that can address inflation and changing needs over time. There's also part-time work or hobbies. Some people are active and after retiring realize they do need to do more, to be more engaged. Part-time employment or having a hobby that can be monetized can help supplement income while providing a retiree the ability to stay active. So those are just a few ideas off the top of my head, and they don't even have to be separate. A person could conceivably combine all of these strategies. Do what works.
A diversified approach not only spreads risk, but also provides flexibility to adapt to life's unexpected changes.
Yes, exactly, Cash. We preach adaptability, flexibility, and resilience. A well-rounded income strategy can offer both stability and adaptability in retirement. Now let's make it real for the listeners. Combing the internets, I've found a number of different articles. Let's look at some real-life examples. From the Times in the UK, the lady by the name of Marion Bloom, 101 years old, after retiring in 1993, she relied on a combination of annuities and downsizing her home to manage living costs. She emphasizes the importance of meticulous financial planning and staying mentally stimulated. And from a December 2024 article in the Wall Street Journal, I came across Rick Larson, who is a retired Air Force colonel. Rick enjoys financial stability through military and private sector pensions. Those pensions provide him the financial flexibility to travel extensively in retirement. There are millions of stories walking around out there and many articles, blogs, and documentaries that you can use as a resource for discovering how others are doing it.
These stories highlight that with careful planning and diversification, retirees can create robust income streams to support their desired lifestyles.
Indeed, Cash, real-life experiences underscore the value of combining income sources and being strategic with assets like property or investments in order to achieve financial security in retirement. This has been a longer run than our other episodes. Are we ready to bring this home?
I've been home all day, my man.
Great. Let's take some action on this. I guess what I have today is a sequence of actions. This week, try to assess your expected income sources. List all potential income streams, including Social Security, pensions, savings, and investments. Once you've identified what will be available to you, evaluate the pros and cons. Consider the advantages and disadvantages of each income source in the context of your personal circumstances. From here, you'll be able to develop a diversified income plan, strategizing how to combine multiple income streams to meet your essential and discretionary expenses. When in doubt, consult a financial advisor, and it never hurts to consult with your tax professional as well. Seek the guidance of professionals who can offer guidance on how to tailor a retirement income strategy that aligns with your vision, values, goals, and comfort with risk. Understanding where your retirement paychecks will come from is vital to building a secure and fulfilling retirement. By evaluating the pros and cons of various income sources and learning from real-life examples, you can craft a diversified income strategy that meets your unique needs. Thanks for tuning in to this episode of The Perfect Retirement Plan. Remember, it's not about having the smartest financial advisor, the most money saved, or the highest probability of retirement success. The perfect retirement plan for you is the one you act on.
It's disclosure time. This podcast is intended for educational purposes only, should not be used for any other purpose. The views depicted in this material should not be considered specific advice or recommendations for any individual, are not intended to be financial, tax, or legal advice, and do not represent Tide Pool Wealth Strategies or Cetera Advisor Networks, LLC. For a comprehensive review of your personal situation, always consult with a financial, tax, or legal advisor. Neither Cetera nor any of its representatives may give legal or tax advice. Our office address is 450 Country Club Road, Suite 350, Eugene, Oregon 97401. Securities and advisory services are offered through Cetera Advisor Networks, LLC, a broker-dealer, registered investment advisor, and member of FINRA and SIPC. Cetera is under separate ownership for any other named entity. Whew.